Being an executor is a major responsibility that can quickly become a burden if you are not set up to do the job correctly. Today, we will discuss the important role of an executor and some big mistakes executors can make and how to avoid them. My name is Chris Zeches, and I'm a certified financial planner and managing partner at Zeches Wealth Management. At Zeches Wealth Management, we have one singular focus: to use our financial planning and tax expertise to help multi-generational families and business owners achieve more of what they love. In line with that focus, the purpose of these monthly videos is to give you actionable advice that may be used to improve your and your family's financial outlook. Today, I want to discuss the important role of an executor and some big mistakes that executors can make and how to avoid them. Being named the executor of a family member or loved one's estate is an honor. The decision shows that this person saw you as a highly trustworthy, capable person of integrity. But it's also a major responsibility that can quickly become a burden if you are not set up to do the job correctly. Administering an estate comes with plenty of potential pitfalls that can threaten your loved one's wealth and your peace of mind. Additionally, without professional guidance, executors can make mistakes that expose the entire estate to litigation, increased tax liability, and other potential consequences. So let's take a look at 5 common mistakes to be aware of so that you can avoid them. The first common mistake executors make is paying out distributions too early. As an executor, you are liable for the estate and its distributions. If you make distributions from the estate to family members before taxes and other liabilities are paid, you are personally responsible. The same is true if you make disproportionate payments to family members. Now, that's not to say you can't make these distributions, but a miscalculation puts you at risk of not being able to get that money back. A second mistake executors make is failing to take the portability election exemption. The concept of portability means that a surviving spouse can use both their federal state tax exemption and the unused exemption of their deceased spouse. As of this filming, the federal exemption is over $12 million per spouse. Now, the estate tax exemption is adjusted annually to reflect changes in inflation. So this would allow the surviving spouse to shelter a combined $24.12 million from any federal state tax liability. While this exemption is permitted, you must ask for to lose it. Even if no estate tax is due, you need to elect portability. Another mistake executors make is failing to properly advertise the estate. Especially if debts are owed, creditors must be notified so that they can make claims against the estate if necessary. Advertising an estate in a local newspaper provides official notice. Each state has some different rules governing advertisement of the estate, so you should be sure to meet those requirements so as you don't expose yourself to personal creditors. The fourth mistake we have seen in the industry is when executors don't liquidate securities in a market downturn. Those appointed as an executor are responsible for managing the estate's assets, including any stock portfolios. That job may involve buying and selling stocks or other securities in response to bull or bear markets. While you don't necessarily need to have the financial acumen of Warren Buffett, failing to monitor the markets and the estate investments could seriously damage the estate's value. As an executor, you're also a fiduciary, meaning you are legally required to act in the best interest of the heirs or other beneficiaries of the deceased person and to follow the instructions the deceased person spelled out for you. That means it falls on your shoulders to ensure the estate's financial health. The fifth and final mistake we will discuss today is failing to close the estate properly. Executors who have properly distributed most of the estate's assets often fail to properly close the estate. This may involve filing a settlement agreement with the court, showing them that all beneficiaries agree that they have received their share of the estate, or going through a court accounting process where a judge approves the distributions. We also recommend you work with an accountant or an estate administration lawyer in more complicated cases to ensure all tax matters are concluded before the estate is closed. As we've just reviewed, there are many details involved in estate administration, and the complexity of estate administration warrants consulting with a professional to help you navigate these details and avoid possible pitfalls. Seeking professional counsel will help you file the proper forms, protect your personal risk, and protect the estate's value to ensure you don't breach your fiduciary duty. As emotions may be high, especially due to an unexpected death, having the proper counsel can help you keep your focus on doing the best job possible as executor for all parties and to make for a smoother process during a difficult time. If you have questions that are specific to your family situation, feel free to contact us and we will do what we can to help. Thank you for listening, and remember, we believe you can have a flexible life plan to achieve more of what you love, more financial confidence, more for your family, more freedom, more choices.